Gold has just shattered yet another all-time high, blasting through 4,600 per ounce in what analysts are calling not just a rally but a fundamental repricing of safe haven assets in an increasingly chaotic global environment. And what makes this surge particularly remarkable is that according to the World Gold Council's latest technical analysis, even at these stratospheric levels that would have seemed like fantasy just years ago, gold is still not technically overbought and has room to run potentially another $17 per ounce to $47,000 before reaching what analysts define as extreme overbought territory based on historical price patterns and momentum indicators, a revelation that has caught many investors off guard because conventional wisdom suggests that assets making repeated all-time highs must be due for a correction. But gold is defying that logic as multiple fundamental drivers: geopolitical chaos, Federal Reserve credibility crisis, inflation concerns, currency debasement fears, and institutional portfolio rebalancing converge to create what may be the most powerful and sustainable gold bull market in modern history. The World Gold Council's weekly markets monitor, published this week, provides fascinating technical and fundamental insights that every investor needs to understand. Because what's happening in gold markets right now isn't just about one commodity's price movement, but rather reflects profound shifts in how global capital is assessing risk, how investors are positioning for scenarios that seemed unlikely just months ago, and how the traditional financial system's credibility is being questioned in ways that benefit alternative stores of value like gold that have maintained purchasing power across millennia, regardless of what happened to governments, currencies, or financial systems that rose and fell throughout history. The immediate catalyst for Monday's explosive move that pushed gold to a new all-time high of 4/20/30/2019 shortly before 11:20:30 m Eastern Time was the Trump administration's unprecedented indictment against the Federal Reserve, an action so extraordinary that it sent shockwaves through financial markets and forced investors to confront scenarios where the independence of America's central bank, long considered the bedrock of dollar credibility and global financial stability, might be compromised by political interference, creating uncertainty about monetary policy credibility that historically drives capital into gold as the ultimate monetary asset that cannot be printed, manipulated, or controlled by any government or central bank. But focusing only on immediate catalysts misses the bigger picture that the World Gold Council emphasizes in their analysis. When geopolitical spikes that used to be temporary and isolated events become frequent and persistent, they stop being viewed as temporary risk events and instead become embedded in baseline risk assessments, forcing investors to permanently hold higher allocations to safe haven assets rather than treating gold positions as tactical trades to be quickly exited once specific crises resolve. And this transition from tactical to strategic gold allocation represents a fundamental shift in how institutional capital views the yellow metal. A shift that has profound implications for price trajectory, because strategic allocations are sticky and persistent rather than fast money that exits at the first sign of trouble, creating a more durable bid under gold prices that makes major corrections less likely and makes the path to higher prices more sustainable. The technical picture that World Gold Council analysts paint is particularly compelling for anyone trying to understand where gold goes from here, because unlike fundamental analysis, which can be subjective and open to interpretation, technical analysis provides objective price levels, momentum, indicators, and pattern recognition that help identify when assets are overextended and due for pullbacks versus when they have room to run higher. And the current analysis suggests strongly that despite 3 new all-time highs in just the first 2 weeks of 2026, and despite prices that have risen dramatically from levels that prevailed just months ago, gold's technical structure remains healthy, with key support levels holding firm and with momentum indicators not yet showing the kind of extreme readings that typically precede significant corrections. Specifically, the analysis notes that gold's short-term 13-day exponential moving average currently sits at 4,440.44 per ounce and has been providing reliable support during the recent consolidation period, meaning that as long as gold prices remain above this level, the immediate trend bias remains to the upside with no technical reason to expect significant weakness. And this moving average has proven its importance by catching multiple minor pullbacks over recent weeks and quickly launching prices back to new highs, demonstrating that buyers are aggressively defending this level and that any dips toward it represent buying opportunities rather than signs of trend reversal. The next significant technical level above current prices comes at 4,585 per ounce, which represents what analysts define as gold's typical overbought extreme, calculated as 25% above the 200-day moving average. A mathematical relationship that historically has marked short-term price peaks where momentum exhaustion leads to temporary consolidation or minor corrections. But even if gold reaches this level, it would not signal the end of the bull market, but rather just a pause for consolidation before the next leg higher, similar to what happened multiple times during gold's historic runs in previous decades, where prices would hit technically overbought levels, consolidate for weeks or months, and then resume their advances to even higher levels. What's particularly interesting is that the World Gold Council identifies 4,000, 7,005 or 70 per ounce as the upper boundary of the consolidation pattern that formed during October through December 2025, a triangle pattern in technical analysis terminology that represents a period where bulls and bears were battling for control, with prices oscillating within a defined range before ultimately breaking out to the upside, and resistance from this triangle pattern now sits at 47,070, meaning that gold would need to breach this level for analysts to consider it truly an extreme overbought territory that might warrant more serious profit-taking, implying that the current rally has another $170 per ounce of potential upside, more than 35% from already elevated levels before reaching zones where technical indicators would flash genuine warning signs about overextension. On the downside, the technical analysis provides clear support levels that would need to break before the bullish thesis comes into question, creating a roadmap for investors to understand at what prices they should become concerned, versus what prices represent normal healthy consolidation within an intact uptrend. And this kind of clarity is invaluable for managing positions and avoiding the emotional decision-making that destroys returns when investors panic sell during routine pullbacks that never threaten the underlying trend. The first support level comes at that 4440.47 per ounce 13-day exponential moving average already mentioned, and as long as this holds, the immediate bias remains higher. But if prices were to break below this level, the next support comes at 448 per ounce, a previous consolidation zone that could provide temporary footing, though breaking below both of these levels would ease the immediate upside bias according to the World Gold Council's terminology, meaning it wouldn't necessarily signal trend reversal, but would suggest that near-term momentum has shifted and that prices might need to work lower to find more substantial support before resuming their advance. That more substantial support exists at 430.45 per ounce, then 4,275, 4,265 per ounce, levels that represent previous breakout points in consolidation zones that typically provide strong buying interest when revisited because they mark prices where previous buyers established positions and are therefore likely to add to positions, or where new buyers who missed earlier entries finally get opportunities to establish positions at better levels. And the fact that these support levels are well defined and based on actual prior price action rather than arbitrary round numbers gives them more credibility because they represent real supply-demand dynamics rather than just psychological price points. The overall technical message is clear. Gold structure remains healthy, the uptrend remains intact, support levels are holding, and there's technical room for prices to move higher before reaching genuinely overbought extremes, a conclusion that aligns with fundamental drivers that continue pushing capital towards safe haven assets, and that suggests this rally has legs rather than being a speculative blow-off top destined for imminent collapse. The fundamental backdrop supporting gold's surge is equally compelling and arguably even more important than technical factors, because while technical analysis can identify when and where price moves might occur, fundamental analysis explains why those moves happen and whether the underlying drivers are sustainable or temporary, and the current fundamental environment for gold is about as supportive as it gets, with multiple powerful forces converging simultaneously to drive demand for the yellow metal from diverse buyer categories including central banks, institutional investors, retail investors, and even industrial users who need gold for technology applications. Starting with geopolitical factors, the World Gold Council's observation that geopolitical risk events are no longer isolated, temporary spikes, but rather persistent, elevated baseline conditions represents a crucial insight about the current investment environment, because for decades investors could treat geopolitical tensions as trading opportunities, buy when tensions spike, sell when they resolve, knowing that the post-war international order generally contained conflicts and prevented escalation to catastrophic outcomes, but that confidence has evaporated as the rules-based international system fractures. As great power competition intensifies between the United States and China, as regional conflicts from Ukraine to the Middle East persist without resolution, as nuclear-armed nations make increasingly aggressive moves, and as the American security umbrella that protected allies for 80 years becomes uncertain, creating a fundamentally different risk environment where geopolitical tail risks are much fatter than historical models suggest, and where traditional portfolio construction that assumed away extreme scenarios no longer provides adequate protection. The Trump administration's indictment against the Federal Reserve represents perhaps the most dramatic example of how previously unthinkable scenarios are becoming reality, because the Federal Reserve's independence from political interference has been sacred in American governance since the Federal Reserve Act was amended in the 1970s specifically to prevent politicians from manipulating monetary policy for short-term political gain at the expense of long-term economic stability. And while presidents have frequently complained about Fed decisions and have sometimes attempted to influence Fed chairs through public pressure and jawboning, actually indicting the Federal Reserve as an institution crosses a line that has never been crossed, and that calls into question the entire framework of dollar credibility, because if the Fed cannot make monetary policy decisions based on economic analysis without facing criminal prosecution for those decisions, then monetary policy becomes subordinate to political considerations. And if monetary policy is political rather than economic, then the dollar's status as neutral global reserve currency becomes questionable, and if the dollar's reserve status erodes, then the entire architecture of global finance that has been built on dollar denomination of commodities, dollar pricing of international trade, and dollar holdings as central bank reserves begins to crack, creating opportunities and incentives for alternatives including gold, which has served as monetary base throughout human history, regardless of what happened to any particular government's paper currency. The inflation dimension of gold's rally deserves particular attention because while official inflation statistics have moderated from their 2022-2023 peaks and central banks have declared victory over inflation and have begun cutting interest rates, the reality on the ground that ordinary people experience tells a different story where prices for essentials like food, housing, healthcare, education, and energy remain dramatically elevated compared to pre-pandemic levels and show no signs of returning to previous levels, creating a permanent upward shift in price levels that has destroyed purchasing power for people living on fixed incomes or wages that haven't kept pace with inflation. And this purchasing power destruction drives gold demand as people seek to preserve wealth against currency debasement. The upcoming U.S. Consumer Price Index data for December that releases on Tuesday is expected to show potential upticks with core CPI potentially climbing to 0.4% month over month compared to 0.4% and 2% in the prior month. And while analysts attribute this to data distortions related to the government shutdown rather than genuine acceleration of underlying inflation, the reality is that any CPI print above expectations reinforces concerns that inflation remains problematic and that central banks' declarations of victory were premature, concerns that drive safe haven demand for gold as investors hedge against scenarios where inflation proves more persistent than policymakers expect and where interest rates might need to remain higher for longer or even increase again. Because if inflation remains elevated while economies weaken, then central banks face the nightmare scenario of stagflation, where traditional policy tools stop working because raising rates to fight inflation damages growth while cutting rates to support growth fuels inflation. And stagflation environments have historically been extraordinarily bullish for gold because gold provides protection against both inflation and economic uncertainty simultaneously while providing returns uncorrelated with stocks and bonds that typically struggle during stagflationary periods. The international economic data that releases this week provides additional context about global growth dynamics, with EK8 November GDP expected to show stalled growth toward the end of 2025, suggesting that Britain's economy is struggling despite Bank of England rate cuts, and Germany's full year 2005 GDP potentially showing only 0.3% year-over-year growth following 2 consecutive years of contraction, illustrating that Europe's economic engine is sputtering badly and that the European economic model is under severe stress from energy costs following the loss of Russian gas, from industrial uncompetitiveness against Chinese manufacturers and American tech giants, from demographic decline and aging populations that increase social spending while reducing productive workforce, and from political paralysis that prevents necessary reforms. And weak European growth matters for gold because it reinforces the global economic uncertainty narrative, and because it increases pressure on the European Central Bank to maintain accommodative monetary policy that weakens the euro and makes dollar-denominated gold relatively more attractive for European investors who see their purchasing power eroding. China's role in gold markets cannot be overstated because Chinese demand has been perhaps the single most important driver of physical gold demand over the past decade, as Chinese households and Chinese central bank have accumulated enormous quantities of gold, and Wednesday's release of China's December trade data, including gold exports, will provide crucial insights into whether Chinese demand remains robust or whether economic challenges in China are causing demand to soften, and the World Gold Council's expectation that the data may show continued resilience as non-US shipments may have, provided continued support, suggests that Chinese gold flows remain healthy despite economic headwinds, which would be bullish for prices because it indicates that one of the world's 2 largest gold markets continues absorbing supply, and because it demonstrates that gold demand is global rather than concentrated in any single region, making the rally more sustainable since it's not dependent on any single country's economic conditions. Chinese gold demand is particularly interesting from a strategic perspective because China has been systematically working to reduce dependence on the dollar-denominated financial system, to internationalize the yuan, to create alternative payment systems to SWIFT, to establish yuan-denominated commodity trading, and to generally prepare for a potential future where the dollar is no longer the undisputed global reserve currency, and gold accumulation serves multiple purposes in this strategy, including providing a non-dollar store of value, creating backing for potential future yuan. Internationalization, demonstrating financial strength and stability to other nations that might use yuan in trade, and preparing for scenarios where dollar weaponization through sanctions drives countries away from dollar-based finance and toward alternatives. And if China's strategic gold accumulation continues, it provides a fundamental bid under gold prices that will persist for years or decades, regardless of short-term market fluctuations, because China's gold buying isn't tactical trading, but rather strategic positioning for a different monetary system. The positioning dynamics in gold markets provide another reason to believe this rally has room to run, because contrary to what one might expect after such a powerful advance, the World Gold Council notes that positioning is still not seen at an extreme, meaning that speculative traders in futures, markets and investors in gold ETFs and other investment vehicles have not yet built the kind of massive long positions that typically characterize market tops, and that leave markets vulnerable to sharp corrections when leveraged traders are forced to liquidate positions, and this lack of extreme positioning is actually bullish rather than bearish, because it suggests that much of the recent price advance has been driven by physical demand and strategic allocation, rather than by speculative leveraged money that reverses quickly when sentiment shifts, and it also suggests that there remain substantial pools of capital that have not yet allocated to gold, but that might do so as the rally continues and as the fundamental drivers become more widely recognized, creating potential for a momentum phase where capital flows accelerate as investors who have been sitting on the sidelines decide they can no longer afford to miss the rally and begin chasing prices higher. This pattern of sustained rallies driven by physical demand and strategic allocation rather than by speculative excess is characteristic of the most durable bull markets in gold's history, including the 1970s bull market that took gold from $35 per ounce to out of $55 per ounce over the course of a decade, driven by inflation, dollar devaluation, geopolitical tensions, and loss of confidence in government monetary management. Conditions that bear remarkable similarity to today's environment, even though the specific details differ, and if the current bull market follows a similar trajectory, then the gains seen so far would be just the beginning of a much larger move that could take gold to levels that currently seem implausible, but that would make perfect sense in environments where dollar credibility is questioned, where inflation persists, where geopolitical conflicts escalate, and where traditional financial assets like stocks and bonds deliver disappointing returns due to economic stagnation or policy errors. The portfolio construction implications of gold's rally and the strategic case for gold allocation deserve emphasis because many investors still think of gold as a speculative trading vehicle or as insurance that you hope never pays off rather than as a core portfolio component that provides diversification benefits and positive expected returns over long time horizons. But the World Gold Council's message that a strategic allocation to gold benefits portfolios in an increasingly uncertain world reflects academic research and institutional practice showing that portfolios that include gold allocations typically have better risk-adjusted returns than portfolios without gold, because gold's low or negative correlation with stocks and bonds means that gold often performs well precisely when traditional assets are struggling, providing diversification that actually works during the times when you need it most, rather than the false diversification that collapses during crises when everything becomes correlated to the downside, as happened during the 2008 financial crisis, when correlations across asset classes spiked to 1 and traditional diversification failed. The specific allocation to gold that makes sense for any individual portfolio depends on personal circumstances, risk tolerance, investment horizon, and other assets held. But institutional research suggests that allocations in the 5% to 15% range often provide optimal diversification benefits, without creating excessive concentration in a single asset class. And importantly, these allocation recommendations are based not on speculation about gold prices, but rather on gold's statistical properties as a portfolio component, including its volatility, its correlation structure with other assets, and its historical returns across different market environments, meaning that gold allocation makes sense even for investors who have no view on gold's price direction, but who simply want to construct portfolios with optimal risk-return characteristics. The rally to $4,600 per ounce means that investors who establish gold positions earlier in this bull market are sitting on substantial profits, creating tax planning considerations and rebalancing decisions about whether to take profits and reduce allocations that have grown through appreciation, or whether to maintain positions based on expectation of further gains. And while these are individual decisions that depend on personal circumstances, the technical and fundamental analysis presented by the World Gold Council suggests that this is not yet the time to abandon gold positions because the drivers remain in place, the technical structure remains healthy, and positioning is not yet extreme, implying that the path of least resistance remains higher, and that investors taking profits now might find themselves forced to buy back at higher prices if the fundamental drivers intensify. Looking forward, the key questions for gold's trajectory revolve around whether the fundamental drivers that have powered the rally continue to intensify, stabilize at current levels, or begin to moderate, because if geopolitical tensions escalate further, if the Federal Reserve's credibility crisis deepens, if inflation proves more persistent than expected, if economic growth disappoints and recession fears increase, then gold has substantial upside potential, perhaps to the 470-40-70 technical target or beyond. But if tensions ease, if the Fed successfully navigates its credibility challenges, if inflation continues moderating, if economic growth proves resilient, then gold might enter a consolidation phase where prices oscillate in a range while digesting recent gains before the next leg higher. Though even in this scenario, a major correction seems unlikely given the strategic allocation, flows, and physical demand that provide fundamental support. The worst-case scenario for gold would involve a dramatic positive shift in global conditions, including geopolitical conflict resolution, restoration of Federal Reserve credibility through political backing away from interference, inflation dropping rapidly towards central bank targets, and economic growth accelerating, a scenario that would reduce safe haven demand and might trigger profit-taking. But this scenario seems extremely unlikely given current political, economic, and geopolitical trajectories that are moving in opposite directions, with tensions rising rather than falling, credibility questions intensifying rather than resolving, inflation remaining problematic despite official narratives, and growth struggling despite unprecedented monetary and fiscal stimulus, suggesting that the fundamental drivers supporting gold remain intact and that the bull market has further to run before reaching a genuine top. For investors watching gold surge and wondering whether they've missed the opportunity, the analysis from the World Gold Council provides reassurance that even at 4,600 par 100 per ounce, gold is not yet technically overbought based on historical patterns, that fundamental drivers remain in place, that positioning is not extreme, and that strategic allocation to gold makes sense regardless of short-term price movements, because gold's portfolio diversification benefits persist across market cycles, though as always investors should size positions appropriately for their individual circumstances and should avoid the mistake of chasing prices with oversized positions that create emotional distress during inevitable short-term volatility. Because successful gold investing, like all successful investing, requires maintaining positions through temporary drawdowns and volatility to capture long-term returns, and the investors who will benefit most from gold's bull market are those who establish appropriate strategic allocations and maintain them through the inevitable ups and downs, rather than those who trade tactically trying to time every short-term wiggle, because, as the technical analysis shows, even skilled analysts cannot predict with certainty whether gold consolidates at 4,900 or runs to 4,900 by 4,799 before pulling back. But what they can say with confidence is that the fundamental environment remains supportive, the technical structure remains healthy, and gold's role as portfolio diversifier and safe haven asset remains as relevant in 2026 as it has been throughout human history, whenever governments debased currencies, when conflicts threatened stability, and when the future became uncertain.